Welcome to Hibiscus Petroleum's Financial Results Webcast. This webcast presents an overview of the results reported as part of the quarterly financial report for the 3-month period ended 30th June 2017 and released earlier today. As 30th June is the end of our fourth quarter, we are also presenting a snapshot of our full year unaudited results. This webcast has been prepared by Hibiscus Petroleum Berhad, i.e. the company solely for general information purposes only, and shall at all times be heard and or viewed subject to the full quarterly report made available or published by the company on its website. This webcast may contain forward-looking statements which are based on current expectations, beliefs, and projections about future events or matters. By listening to and or viewing the webcast, you agree to the limitations and notifications set out in the disclaimer section of this webcast. There are 5 parts to this webcast. In part 1, Pascal Hoss, Vice President of New Ventures and co-founder of Hibiscus Petroleum, will take you through a brief introduction of the company. Also, in part 2, Devarajan Indran, Vice President of Petroleum Engineering, will provide an overview of our main asset, the Anasuya Cluster. In Part 3, Yip Chi Yong, or CY, Vice President of Finance and Group Controller, will follow up with highlights of the company's fourth quarter results and full year unaudited results. In Part 4, Pascal will briefly touch on details of our proposed acquisition of a 50% interest in the 2011 North Sabah Enhanced Oil Recovery Production Sharing Contract. He will then conclude with some of our key messages in Part 5. Should you have any queries, you may contact our Investor Relations team via the email address provided at the end of this presentation. I shall now pass you on to Pascal.
Hello, this is Pascal Hoss, Vice President of New Ventures. Let me commence by providing you with a brief introduction to our company. Hibiscus Petroleum was listed on the main market of Bursa Malaysia in July 2011. We listed with the intention of being involved in both exploration and production activities. Initially, our activities were more focused towards exploration, but since 2014, when U.S. shale-related oil production catalyzed a drop in oil price, we have refocused our goals, concentrating the growth of our business by revitalizing mature producing assets safely and profitably in regions of our geographic focus. Our joint ownership of the Anasuya Cluster of oil and gas fields in the UK North Sea in this regard is consistent with our goals and has been significant in generating positive cash flow and profit for the company over the past year. From Anasuya, we are producing an annual average of more than 3,500 barrels of oil equivalent net to our company on a daily basis. Our current portfolio of assets is spread across 2 geographical locations, i.e. the United Kingdom and Australia. A second producing asset has been conditionally secured in Malaysia, and we are working towards meeting the conditions required to transfer the working interests in the 2011 North Sabah EOR PSC to us. Our company currently has total proven and probable, or 2P oil reserves of about 26 million barrels. This primarily consists of 6.5 million barrels of proven undeveloped reserves located in the Vic L31 West Seahorse asset in Australia, and about 19 million barrels of proven undeveloped reserves located within the various fields of the Anasuya Cluster in the UK North Sea. Dev will now go through this in more detail in part 2 of this webcast.
Hello, I'm Dave, Vice President of Petroleum Engineering. I'll now take you through some information on our key asset, the Anasuya Cluster, which is located offshore the United Kingdom. To recap, we completed our acquisition of the Anasuya Cluster from Shell and Esso on the 10th of March 2016. This means that we have held the joint operatorship of Anasuya for about 15 months now. More significantly, for the purpose of this webcast, it means that the financial results we are now presenting comprise a full financial year of Anasuya Cluster financial and operational performance. The Anasuya asset is located about 175 kilometers east of Aberdeen and has been producing since 1996, with an estimated remaining economic life of approximately 19 years. Our interest in the Anasuya Cluster comprises a 50% interest in the Teal South, Guillemot A, and Kite fields. We jointly operate these fields together with our partner, Ping Petroleum, through a jointly owned legal entity incorporated in the United Kingdom called the Anasuya Operating Company. The cluster also includes the Cook Field, and we have a non-operated 19.3% interest in this asset. Included as part of the Anasuya Cluster are all the installed subsea production infrastructure and the floating production storage and offloading vessel, the Anasuya FPSO. Taking a look at the field layout, the subsea infrastructure underpinning the production of hydrocarbons is quite extensive and spans 25 kilometers from north to south. Our confidence to jointly operate this asset is derived from the existing knowledge and experience of Hibiscus and Pink personnel, some of whom have previously worked in the UK North Sea environment. Operating risks are further mitigated by the fact that we are also utilizing the services of Petrofac, a reputable international service provider, in the role of offshore duty holder. That said, the financial performance of our Anasuya asset is subject to a few external factors. We are exposed to movements in oil and gas prices. Foreign exchange rates also play a role as we recognize our revenues and valuation of Anasuya in US dollars, while the bulk of our operating costs for the asset are incurred in British pounds. But as a Malaysian listed company, we ultimately report our results in ringgit. As we can't control the previously mentioned factors, we focus our efforts in managing the production performance of the wells, facilities uptime, and operational costs of the Anasuya asset. Over the 15-month period under our joint operational control, several milestones have been achieved, which are reflected in the performance indicators shown on this slide. For today, however, I would like to review our operations for the period from April to June 2017. In this quarter, we recorded an increase in the average daily oil production rate to approximately 3,200 barrels a day, compared to the average daily rates achieved in the previous quarter. Together with gas exported, our total oil equivalent production rate for the quarter was an average of approximately 3,500 barrels a day. The average facilities uptime of 84% represents an improvement for this quarter when compared to that of the preceding quarter. By working in advance with the oil trading group at BP who market our crude, and by maintaining the uptime of our production systems on the FPSO, we were able to commit to sell an increased volume of crude oil in this quarter. The total oil sold was about 285,000 barrels of oil. The crude oil price realized by the company for the oil sold during the quarter was approximately $50.5 per barrel. Further to this, the operational expenditure remained low, with the OPEX per barrel for the quarter maintained at a level below $20 a barrel. The increase in the average daily oil production rate and facilities uptime compared to the previous quarter has offset the impact of a slightly lower realized crude oil price that was achieved for our fourth quarter oil cargo. In addition, we tested and reopened 2 wells which were shut in by the previous operator for high hydrogen sulfide or H2S production levels. The 2 wells, Guillemot P1 and Teal South P1, are both currently online and contributing to daily production figures. To maintain H2S levels below the permissible gas export limits, various chemical points of injections at the Anasuya FPSO have been added. We expect a positive financial impact in respect to the implementation of these initiatives to be observed by the end of calendar year 2017. Further to this, we have identified several projects which can be executed during the period commencing mid-2017 and continuing until mid-2018. These projects are on track and will enhance production volumes by bringing on stream petroleum resources that have already been discovered. Recognizing the fact that we are building up our project execution experience in the UK sector of the North Sea, our strategy in Anasuya has been to commence activities that are low in technical complexity and business risk exposure. We are excited by the potential of the projects we have in our pipeline, and to ensure timely and smooth execution, we are putting in place the necessary financing. I will now pass you on to CY for part 3 of this presentation.
Hi, I'm CY, Vice President of Finance and Group Controller, and I'll take you through the financial highlights for the quarter. In the fourth quarter ended 30th June 2017, the Anasuya segment reported earnings before interest, tax, depreciation and amortization, or EBITDA, of approximately 55 million ringgit. This represents an approximate 38% increase in EBITDA when compared to the preceding quarter. The EBITDA margin of 75% in Q4 also grew when compared to the 59% achieved in Q3. As can also be seen, The Anasuya segment contributed to a profit before tax of 38 million ringgit for the quarter ended 30th June 2017. Whilst profits are extremely important, management's focus remains on delivering strong and sustainable EBITDA levels as business continuity is of the highest priority. Finally, we have taken a 19 million ringgit tax charge in this quarter. It is shown as part of the Anasuya segmental results and is the amount which represents the balance of total taxation obligations for the financial year ended 30th June 2017. This tax charge was incurred as a result of the net income generated by Anasuya Hibiscus UK Limited for the sale of crude oil and gas from the Anasuya Cluster. We believe that the capital projects we are implementing over the next 12 months will reduce the tax payable in the next financial year. We believe that the two tables presented on this slide best demonstrates the transformation that has been delivered to our company by the Anasuya asset. For the full year ended 30th June 2017, or FY 2017, the group recorded a net profit of 106 million ringgit, which represents a positive swing of 166 million ringgit from a loss of 60 million ringgit recorded in the previous financial year ended 30th June 2016, or FY 2016. Group revenue for FY 2017 also increased by approximately 220% to 261 million ringgit when compared to approximately 82 million ringgit delivered a year ago. Over the past few quarters, every significant component of our balance sheet has been gradually strengthening. We have built our total assets and shareholders' funds to 1.3 billion ringgit and 74 million ringgit respectively. In addition, the cash position of the group is healthy, with cash and bank balances amounting to 54.5 million ringgit. You will also recall that when we purchased the Anasuya cluster of assets, there was a component of the total purchase consideration of $52.5 million that was deferred. This deferred consideration component of the purchase consideration amounted to $22.5 million. On the 10th of March this year, we fulfilled a payment obligation of $15 million towards this deferred consideration component. On 10th September 2017, we hope to be able to settle the payment of the final tranche of deferred consideration amounting to $7.5 million. I will now pass you back to Pascal to provide a brief recap on our proposed acquisition of a 50% participating interest in the Malaysian 2011 North Sabah Enhanced Oil Recovery Production Sharing Contract, or PSC.
In October last year, we announced an exciting new proposed acquisition when we entered into a conditional sale and purchase agreement with Shell. This was to acquire Shell's entire 50% participating interest in the 2011 North Sabah Enhanced Oil Recovery Production Sharing Contract, or PSC. The SPA also includes interests in the joint operating agreement currently between Shell and Petronas Carigali in relation to the PSC. This transaction marks our second deal with Shell internationally and is consistent with the group's strategy of having interests in producing late-life fields in safe jurisdictions. The North Sabah EOR PSC has been producing since 1979 with production rights up to 2040. The deal includes the operatorship of 4 producing oil fields offshore Sabah, the Labuan crude oil terminal, and all other equipment and assets related to the PSC to be transferred to Hibiscus Petroleum. As reported by Shell at the end of 2015, the asset had an average daily production of 18,000 stock tank barrels per day. Our independent valuation performed by Risk Operations Private Limited estimated the asset to hold 62 million barrels of remaining reserves and 79 million barrels of contingent resources. Overall, we believe this asset holds a great deal of potential. On 29 May 2017, we announced that Petronas Carigali had waived their preemption rights under the joint operating agreement with Shell. In our announcement, we also stated that Petronas had provided its conditional approval to Shell for the assignment of their interest in favor of C. Hibiscus. Subject to the clarifications and subsequent closure of the conditions, we are aiming to complete the proposed acquisition by the second half of 2017. Before we wrap up, I would like to highlight a few takeaway points. As we have demonstrated consistently over the past full year, the Anasuya asset has transformed and is continuing to positively impact the financial performance of the company. EBITDA and profit numbers have materially increased in a landscape where oil prices have ranged between $45 and $50 per barrel. Strong EBITDA performance is enabling reinvestment plans into the asset to be crystallized that will enhance well production and increase FPSO uptime over the coming 12 months. The next year is expected to be exciting as we plan to execute projects in the North Sea and complete the acquisition of the North Saba asset. Our performance is sensitive to oil price levels. Currently, the futures market is in backwardation, indicating a gradual tightening of supplies. And that's all we have for this quarterly and full year earnings webcast. Thank you for tuning in.